Hey everyone, welcome back to Corporate Decoder, the place where we decode the world of finance and bring you the real story behind the numbers. Sometimes that story involves a whole lot of borrowing, but today we are diving into Bausch Lomb Corporation. And spoiler alert, it is all about loans refinancing and a bit of a financial shuffle, so bud. Keckle up because we are about to break down what is really going on. We have an interesting filing from Bausch Lomb Corporation, a company many of us know for its eye care products like contact lenses and surgical equipment today. We are looking at a specific announcement they made on the 12th of December 2025, what they are calling a credit agreement refinancing. And if you like this kind of deep dive into company filings, make sure you are subscribed. We release these every week and we have a fantastic community over on our Discord server, linked in the description below so you can chat with other finance enthusiasts and get even more insights. So what exactly is this refinancing? Bausch Lomb announced they are taking out new loans totaling a massive $2,802,125,000. These are called replacement term loans and their main purpose is to pay off older loans. The company is essentially swapping out its existing debts for new ones. Why do companies do this? Well, often it is to get better terms like lower interest rates or to push back the date when the money has to be paid back. Let's talk about those terms. The applicable margin, which is basically the extra percentage you pay on top of a base interest rate, is expected to be 3.75% per year for loans. Tied to something called term SOFR and 2.75% per year for loans tied to an alternate base rate. Now that might sound like a small difference, but for billions of dollars it adds up. This represents a reduction of 0.50% per year compared to their old loans due 2031, and a 0.25% reduction compared to their loans due 2028. The new loans also come with a new maturity date, meaning when they have to be fully paid back for the loans that were originally due in 2031. The new ones will also be due in January of 2031, so no change there, but for the loans that were due in September 2028, they are now extended all the way to January 2031. That is a pretty significant extension, giving the company more time to manage its debt. Now, it is important to note that this is not a done deal, yet the company anticipates these transactions will be completed in the first quarter of 2026, but they can't guarantee it. Of course, things could change, and they might not be able to get these new loans on the terms they expect or at all. This announcement is tied to a press release which is included as an exhibit to this report. Think of it as the official announcement that investors and the public will see. What is interesting here is that the company is also using this opportunity to talk about forward-looking statements. These are essentially educated guesses about the future based on current information and management's expectations. They are giving us a heads up that the language they use might include words like anticipates, seeks, expects, plans, should, could, would, may, will, believes, potential, pending, or proposed. These are all signals that they are talking about future possibilities, not guaranteed outcomes. They also remind us that actual results could be quite different due to various risks and uncertainties. The company points to its other filings with the US Securities and Exchange Commission and Canadian Securities Administrators for more details on these risks and uncertainties. This is standard practice where companies disclose potential problems that could affect their business, like market changes, competition, or economic downturns. They are essentially saying consult our other reports for the full picture of what could go wrong. So what does this all mean for Bausch Lomb? Well, on the surface it looks like a smart financial move. They are taking advantage of what is likely a favorable lending environment to reduce their interest costs and extend their debt repayment. The new loans are for almost $2.8 billion, which is a substantial amount of money, and getting a lower interest rate on that kind of principle is a big win for their bottom line. Remember, Bausch Lomb is a publicly traded company. They have common shares listed on exchanges like the New York Stock Exchange and the Toronto Stock Exchange. When a company improves its financial structure by reducing debt costs, it can positively impact its profitability, which in turn can be seen favorably by investors. It can also mean they have more cash flow available for other things like research and development, expanding their business, or even returning money to shareholders. The report is signed by Sam Eldasuki, the Executive Vice President and Chief Financial Officer. This is the person who is responsible for managing the company's finances and making these kinds of strategic decisions. It shows that this refinancing is a key priority for the company's leadership. Now let's look at the bigger picture from a Warren Boo. Fed-style perspective companies often refinance debt when they are confident about their future ability to generate cash flow. If they were struggling or expected tough times ahead, they might avoid taking on new debt or extending existing obligations. The fact that they are refinancing and seem to be getting better terms suggests management has a positive outlook for Bausch Lomb. However, There are always risks with debt, even with improved terms. Big debt loads can make a company vulnerable to economic downturns or unexpected events. A significant increase in interest rates could also make these loans more expensive. If they are tied to variable rates the filing mentions, they are using term SOFR or an alternate base rate, so we will need to watch those benchmarks, the M, at. Maturity extension for the 2028 loans is also notable. It could mean they anticipate needing that flexibility, or perhaps they are betting on continued favourable market conditions. The closing in the first quarter of 2026 is something to keep an eye on. If it slips or the terms change, it could signal underlying issues in conclusion. Bausch Lomb is making a C. Calculated financial move to strengthen its balance sheet by refinancing its debt. This seems to be a strategic step towards improving profitability and financial flexibility. If successful, it could be a positive development for the company and its shareholders. However, like all financial maneuvers, it comes with its own set of risks that investors should be aware of. The company's ability to execute these transactions and the future performance of its business will ultimately tell the full story. Alright, that is our breakdown of Bausch Lomb's latest filing. What do you think about this massive refinancing deal? Does it signal strength or a hidden concern? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe if you want more deep dives into company reports like this. Don't forget to check out the Discord link in the description to join our growing community. Thanks for watching, and we'll see you next time.